The recent surge in inflation has become a concerning economic trend, as consumer prices are rising at a pace not seen in many years. Inflation erodes the real value of money, making it a significant concern for investors. When the rate of return on investments does not outpace inflation, the purchasing power of your money diminishes over time. This underscores the importance of carefully managing your investment portfolio to seek returns that not only beat inflation, but also provide real growth. Diversifying investments, considering inflation-protected assets, and regularly reviewing your investment strategy are essential steps in safeguarding your financial future in an inflationary environment. Here are 10 tips to help safeguard your investments against inflation. Number 10. Focus on total returns. To protect investments from inflation, focus on total returns rather than just income. Assets with both capital appreciation and income, like stocks and real estate, have a better chance of outpacing inflation. Diversify your portfolio across asset classes like equities, bonds, real estate, and commodities to spread risk and enhance total returns. Regularly review and adjust your investment strategy to align with financial goals and economic conditions to maintain your portfolio's ability to combat inflation and preserve purchasing power. Number 9. Explore active management. Active management is a prudent strategy for navigating inflation. It allows portfolios to adapt by rotating into assets resistant to inflation and mitigating risks. This approach complements passive core portfolios and can seek inflation-resistant assets like types, commodities, and energy and materials, which we will later talk about in the video. However, it's crucial to select active managers with a clear investment philosophy that aligns with financial goals. Balancing active and passive strategies can provide a well-rounded approach to navigating inflationary challenges in investment portfolios. Number 8. Review portfolio regularly. Regularly analyzing your asset mix is crucial for aligning investments with inflation protection goals, especially as economic conditions change. Conducting annual or significant reviews of your investment strategy ensures your asset allocation matches risk tolerance, time horizon, and inflation protection objectives. If necessary, rebalance your portfolio to maintain your desired mix. Staying informed about economic trends, inflation forecasts, and market conditions helps make informed decisions about investment choices. By proactively monitoring and adjusting your asset mix, you can better position your portfolio to withstand inflation challenges and achieve long-term financial goals. Number 7. Maintain cash cushion. Having a sufficient cash reserve is crucial during times of market volatility, as it provides flexibility and liquidity for seizing investment opportunities. This can lead to long-term gains once markets stabilize. However, it's essential to strike a balance between having cash for opportunities and avoiding overexposure to inflation. Financial experts recommend maintaining an emergency fund and having additional cash for investment opportunities, allowing individuals to navigate inflation and market volatility confidently while pursuing long-term financial goals. Number 6. Assess bond holdings. Rising inflation can significantly impact the value of fixed-rate bonds, making their future interest payments less valuable. To mitigate this risk, keep bond holdings short, as short-term bonds have lower interest rate risk. Be selective about bond issuers, choosing government or high-quality corporate bonds from financially stable companies. Consider bonds with inflation protection features, like Treasury inflation-protected securities, Type ES. Regularly reviewing and adjusting bond portfolios can help maintain a more inflation-resistant fixed income allocation. Number 5. Invest in commodities. Commodities like oil, gold, and agricultural products are effective inflation hedges due to their price increases during inflationary periods. To gain exposure to commodities in your investment portfolio, consider commodity exchange-traded funds, ETFs, or investing in stocks of commodity producers. ETFs track commodity price movements, providing a diversified and cost-effective way to participate in commodity markets without direct physical ownership. Investing in commodity producers' stocks can indirectly expose them to price movements, potentially increasing profitability and stock price appreciation. Maintaining a balanced and diversified approach is crucial to protect investments against inflation's eroding effects. Number 4. Seek dividend growers. Investing in companies with a history of consistently increasing dividend payouts can help combat inflation's erosion of purchasing power. These companies have a strong financial foundation and steady cash flow, making them more likely to sustain and grow their dividends over time. Focus on companies with robust earnings growth, manageable debt levels, and a competitive industry position. Reinvesting dividends can further enhance the compounding effect, while diversifying across different sectors can reduce vulnerability to sector-specific economic challenges. This approach provides a reliable source of income and helps maintain purchasing power in inflationary environments. Number 3. Explore real estate. Real estate investments have historically outpaced inflation due to property appreciation and rental income growth. Real estate investment trusts, REITs, provide a convenient and liquid way to access these investments without owning physical properties. REITs own, operate, or finance income-producing real estate assets and distribute at least 90% of their taxable income to shareholders. They offer exposure to capital appreciation and income generation while maintaining liquidity. However, selecting REITs that align with investment goals and risk tolerance is crucial for a well-rounded and inflation-resistant portfolio. Number 2. Consider TIPS. Treasury Inflation-Protected Securities, TIPS, are U.S. government bonds designed to protect investors against inflation. The principal value of TIPS is indexed to the Consumer Price Index, CPI, ensuring that as inflation increases, the principal value of your holdings increases. In deflation, the principal value decreases, but the U.S. government guarantees that you will never receive less than your original investment at maturity. TIPS pay both a fixed interest rate and additional inflation-adjusted interest, making them a valuable addition to a diversified portfolio. Number 1. Invest in equities. Stocks have historically proven to be one of the most effective inflation-beating investments over the long term. Companies with strong pricing power and the ability to raise prices in response to inflation are particularly attractive in inflationary periods. These companies can maintain or even improve their profit margins as they pass on increased costs to consumers. Sectors like technology, energy, and materials often include companies with such pricing power. Technology companies may offer products and services with increasing demand, while energy and materials companies can benefit from rising commodity prices during inflationary phases. When investing in stocks during inflationary periods, it's essential to maintain a diversified portfolio to spread risk. Additionally, consider the fundamental health and financial stability of the companies you choose, as strong fundamentals are critical for long-term success in any economic environment. By focusing on stocks with pricing power, you can position your portfolio to potentially outpace inflation and achieve meaningful returns over time. That's it from this video. Let us know what you think about this video in the comments section below. Please make sure to like, share, and subscribe to the channel. Thank you.